$3,110. This is what our trading student did after 2.5 months learning the systematic. And the difference between somebody who's making money or not, what I realized with a lot of trading students is that this trader within 1 month, you can see that he saw 37 trades. And out of 37 trades, he traded only 9 trades. That means the more faster, not only by the trading day, by trading day, that means if you trade for 2 hours, if you trade for a week, if you trade for months, the more higher and the quality of information you get and the faster, the better high quality decisions you can make for your trading, and also the better also the trading account also looks like. So we call this one SL analyze. That means he was analyzing losing trades. He was analyzing winning trades because there are trades that are good and they don't work out. And then you can see here how he gathers here more and more experience until he's ready to place the trade. And you see then how he took 9 trades, how he had 8 winning trades and 1 losing trade, and how he was also writing down all those 28 trades with 18 that worked and 10 that didn't. We're going through some trades, and then also a thing that I saw with somebody who's even experienced, who has 5 years trading experience in trading, how he manages right now to improve his trading. And I hope maybe you see yourself there and can also improve your trading here. So first of all, you see here how he sees here many trades. You see here within here's sitting down on the computer, he's online here, he sees the first trade here, he says he's analyzing it, goes just wiggling around, and then he doesn't see any trade anymore. Later on, he's online again, and then he's taking a trade, adjusted $100. You see here $840 trade, and adjusted here $100. You see here $810 trade, what he took. Then on another day, you see the next trading day, he sees 1, 2, 3, 4 trades he saw here, and out of the 4 trades, he took 3 trades you see here. So it means you see here, 1 trade he took here up, then he was trading here, then he was analyzing, and then he was trading. And we're going through these 3 methods that we use. And this is something what is very important. And this is also where this participant is also going to improve his trading, because the difference, someone is not trading right now currently with 5, 10, 30, 100, or even $500 is because he haven't put in exactly this work inside. Is how many trades did you saw current month? And what were the top percent out of it? So we have 3 types of things, what I really love, and this is called the analysis trades. We call them just like A1, A2, A3, A4, and so on. That means what were the trades based on the trading strategy and the trading setup that you saw that have worked and have not worked. Be honest there with yourself, what you really would have traded, what you really saw working out, and the difference between you today and in 3 years using the same trading strategy is just that you have higher standards, that you see more, that you want to see more quality into that. So that means analysis trades, maybe within 1 trading day, we see 3 to 5 trades that we see first, but later on the more experience you say you know what, 50% of that is also bad. So you maybe see 3 trades every 1 or 2 hours trading. This is a good average. The real trades then from that is if you have seen 10 times something worked out or haven't worked out, and you see the upper 10 or 20%, as you saw also with the trading student, he analyzed 37 trades, around 40 trades, and you took 9 trades. And that's just 1/4, around 30% out of it. That means every 4th, every 5th trade, we see that is working or not working. We know exactly what had more quality, what had less quality, and this is what the trader was then trading. Then we have something that is called a learning trade. And this is something what we add, and this is if the market did the move already, what did we saw, what we didn't expect that the market does? And then a learning trade can go to an analysis trade because we see it multiple times occur, maybe 5, 10, 20 times. And then out of the 20 times we saw it, maybe we're trading it around 4 times of that. Here's the thing, I had a conversation with a trader today, and the conversation was about this picture here, that he missed the trade down here by a movement that didn't occur yet. Then the market was making a certain amount of move, and he says he would trade somewhere here in between and expect the market does the same move again. Cool thing, by the way. But here's the thing now. He sees that the market is somehow turning, reversing, right? And he says here would be his second trade. And he traded then for 1 or 2 hours, and all he did was only 2 trades, and 1 trade he said he missed. And this is called FOMO, fear of missing out. You have this a lot with a lot of traders because their trading strategy is not built that good. That means that tells you analyze first 10 trades or 20 trades and then start trading. Most trading students so far with us, they analyze starting 1 or 2 months. That means like maybe they trade like 2 or 3 times a week in average for 1 or 2 hours. And they're only analyzing everything without taking a single trade using their demo account. But then after the second month or 1.5 months, depending on the person starts trading with his demo account. And then we have people starting 3 months to 7 months. They are going by their own behalf, because this is no financial advice, who are trading with their real money, made it so far a second or third time to duplicate their real money account. I think it's good to start small first, using a demo account, using a real money account, maybe $200, and then flipping the $200 multiple times. And somebody who flipped a $200 account like 3, 4, 5 times, of course, he's more confident enough to work on a bigger account size than somebody who doesn't even manage to trade on a demo account, who doesn't even manage actually to do these analyzing trades as I just showed you. So here you see the solution to that. The difference between trader 1, who is failing right now, who has big struggles and just saw 2 trades, and he's trying to trade these things, by the way, without even reading properly. You see here method, this is called within length. We see here 1, 2, 3, 4, 5 times the market does the same moves. I will show you how I'm seeing this one. You see here from here to there, the market pushes up. And then you see from here to there, the market pushes up again. And then it's starting to wiggle around here. The wiggling around alone had almost the same length here. So that's 1, 2, 3. Then you see that how after wiggling around afterwards that the market was pushing up. So you have seen 4 lengths without even trading. This is something what's very important. Not trading, not just hopping in. Where he traded, I think, is actually very good, because he saw already like the market does here, instead of 1 move, now you see here the market does 2 moves. And when having a good trading strategy, that tells you their only setup in the trading strategy, their only reason to enter a trade is to measure how far the market was coming back. And if the market comes back again, just a red and a green candle like here or there, and the market did this move and this move, expecting the market does the same move again. So when having enough leverage and adjusting here $100, this is a $500 trade. And this is something what is very important, to see only these trades first, multiple times that it occur. And then we go now to the picture here. As you see here, we see here 5 times the move occur. And then we see also here, as I just said, color switches. Only red and green candles are enough for trading up, green and red for trading down. You see here 7 different opportunities. And as I just mentioned, these 7 trades, they should all be analyzed as trades. This has, with that saying, I mean, we want to see only that it worked. And when seeing it 10 times, then only maybe trading 1 or 2 times out of that. And this is how trading works. And this is the work what you see most traders don't do. And I see a major problem. Also, they fail. A second thing also is our trading indicators. You see the move from here to there took around 15, 20 or 30 minutes. And when you use a 5-minute chart, not only that you have extreme huge candles, the biggest problem is just that you have 4 candles or 5 candles and the move is already done. If you are already a person that does the issue to use trading indicators, they calculate within the last 4 or even 20 or 200 candles. That means when it calculates you, the market is going up at this point, the move is already over. So instead, when you use a 1-minute chart, you get the most high quality information so fast as possible. And there are many times where the market starts to wiggle around. We're going through this, why it's so important not to expect that the market is moving here. It is very important that you understand when you use a 1-minute chart, you can literally see how the market does 1, 2, 3, 4, 5, 6, 7, 8, 9 green candles and only 3 red candles. So majority of candles are green. And if you only would take actually a trading zone within the last, actually it starts already when the market just makes more than 3 green candles, by the way. You see here how the market does 1, 2, 3, 4, 5 green candles. And if you only get from the starting the green candles to the end of the green candles, very often within the same time almost, as you see here, within the same candles. Check this out. I just marked here that you understand is 1, 2, 3, 4, 5, 6 candles. 7, 8 with the small retracement. Now check this out. The market starts to make here after pushing out around within the same time. Sometimes it takes double amount of time that the market does the move. But it is about you get within just like 5 candles, 10 candles in a 1-minute chart within 10 minutes. Very high quality information. Is the market pushing up? Is the market not pushing up? And we can start using our analysis trades here. If we go here into this Excel sheet, You can see here how he had his analysis trade. And most trades here, it says here dollar win here at the top. It means that most trades that he saw had $500 in average in win. There are many trades, they go above $500, and this is called the, we say additional max risk reward here, CR3. And this means that you can see here a $500 trade would have worked out to a $1,583, for example. Or we saw here the $1,400 trade would have been also $600 additional that we saw afterwards. Here, there we go. Here we see it. The 6.2 risk reward means, because we adjust always $100 instead of taking $620, as you see here, would have been $900. But the mathematical side is, if I have $1,000 divided into 10 trades, that's $100 a trade. That may be, by the way, a $3,000 or $5,000 account. I only need to have 2 winning trades of $500. That's $1,000. And I could have even 8 losing trades not to lose money. And that's something what's very important, because if I lose 8 times $100, I lost $800. But if I make 2 times $500, I made $1,000. That means I made $200. And in the money-making activity, just trying to have at least 3-4 winning trades, and the rest out of 10 could be all losing trades. And when wanting to make more money, I think it's not to increase the risk-reward ratio. It's not to increase too much quantity of trades. I believe in it's more to increase the money we use for each trade, and to let ourselves so much time as possible, as you see here, to analyze so much as possible, and then to place our single trade. And to see that the trade was $250 where he exited the trade, but it was running up to a risk reward of 8.6, as you see here. So he could have made $860. He should have made here the $500 trade, and that's it for the next trade. And just go on with that. So let's go back to the picture. And if you have any questions about this, let me know in the comment section. I hope this helps you out. So the difference between somebody who's just seeing like, he missed the trade here because there was a push that he didn't expect it, that he's trading here the first trade. And then he sees here somewhere the market is turning around and does here the second trade. Between the other trading example, what I just showed you, is just that the other person is seeing 10, 20 times more trades than the other one. The other trader here saw 37 trades within a month. He's also writing down just trading, by the way, only 1 or 2 hours at a time. Did you understand that? Has only one trading setup, what is a red and a green candle using a 1-minute chart. And the difference is just out of 37 trades, he traded 9 trades. And this is the reason why he had 8 winning trades, 1 losing trades, and made $3,110 for this month.